right. Thanks very much, everyone, for being here today. Sorry we're a few minutes late. We will take one more minute before we get started officially, but while you're waiting, I will say my usual speech. Go to the bathroom, go grab your lunch, whatever you need to do, and we'll get started in about 45 seconds. All right, I'm going to call that 45 seconds. I've turned off all of my noise making devices, so I'm good to start. So, thanks very much for joining us today. The title of the presentation today is The Buffett Blueprint: How Smart Investors Are Lowering Risk and Boosting Returns in Today's Turbulent CRE Market. And joining us today is Paul Moore, which is no relation to me, Matt Moore. Just as an introduction, I do business development here at Camoplan, and we are always excited to have folks come in and share some knowledge with our client community. Quick disclosure before we get started. This presentation is meant for educational purposes only, so Camoplan doesn't provide any investment advice. We encourage you to go seek out the advice from the appropriate individuals like CPAs, attorneys, advisors, and just do your own due diligence before making any investment decisions. If you have any questions that don't get answered after the presentation, or you want to learn more about a self-directed topic, you can always reach out to us at the contact information in front of you. And then finally, housekeeping topic item is that we will have the chat off today, as always, but please ask questions through the Q&A function. I'll be monitoring those. These presentations are always better when it's a dialogue, so please, please, please ask your questions. Don't be shy, and we'll go ahead and get started. So, Paul, I'm going to stop sharing my screen and turn things over to you.
All right, we'll see if we can make this work, Matt. How's that
Great.
look?
Perfect.
All right. Hey, everybody. Happy first quarterly tax payment day of the year. Today, we're going to talk about one of my favorite, maybe your favorite investors of all time, Mr. Warren Buffett. We're going to touch on that, and we're going to talk about how his principles can teach us how to be better real estate investors. So, like Matt said, we're not related, but I am the founder of Wellings Capital. Been married for 38 years, 4 kids. We've got 8 funds at Wellings Capital. I've written a couple books, one on multifamily investing, called it The Perfect Investment, till I went on webinars and blogs and podcasts for the next several years saying it's not the perfect investment. And we'll talk more about that later. I also have a book called Storing Up Profits that was published by Bigger Pockets about self-storage. Wellings Capital was founded about 11 years ago. We have over 200 million in investor equity, investing in about 500 million in projects. We are diversified across different asset types like self-storage, mobile home parks, RV parks, light industrial, multifamily, and commercial retail centers. We invest with 23 operators as of now. We're on my partner's on a due diligence trip to possibly add a 24th in the next few weeks. That's all well and good. But today, why don't we spend a few minutes talking about something you're all really interested in, and that is the history of flight. So, in the early 1800s, pioneers like Otto Lilienthal developed gliders that could kind of get up in the air a little bit. They were super simple. They had no power. They couldn't be maneuvered. They were often crashed, like the second iteration of flight. And that was folks like Samuel Langley. They named the Air Force Base after him, though he was honestly considered a failure by many at the time. He never was able to fly. These large engines they added just They had no stability, they crashed a lot, and they just didn't work. Now, the third iteration of flight was our famous friends from Dayton, Ohio, the Wright brothers. In 1901, after another failed flight attempt, Wilbur Wright famously declared, "Not within 1,000 years would man ever fly." But of course, we know that 2 years later, they combined powered aircraft with Lilienthal's principles of aerodynamics. They set up their own axis control system and they were able to fly. And of course, we know that they were, these were rudimentary and they're honestly fragile. But here we are, about 100 plus years later, and we're enjoying modern flight, and we all know that. So my firm has gone through a similar iterative process in investment strategies. And I've found that that journey we've been on, which sort of parallels flight here, can give us some ideas on how to get a better risk adjusted return when we invest. So let's jump into that. First of all, let's start with a little class project. We all know that low risk leads to high return. So fill in the blank. Low risk leads to high return. So high risk leads to blank return. If you said high, you probably gave the most common answer if you thought that, but it's not the right answer. The problem is low risk leads to low return. That's all agreed. But high risk leads to high potential return and high potential loss as well. And we all know that when we think about it. This graph from Howard Marks really kind of shows a little more accurately what it's like. In fact, it's worse than this because not only does it higher risk give a higher array of probable outcomes, it could go down here. I mean, you could even lose money. You could lose your principal. And we all have had that happen or heard about it. I'm sure you heard somebody lost money in real estate in the last 3 years. I'm not sure who, but this this leads me to our 4 iterations in our investment strategy over the last several years. And we started out where most of you do. I started out in 1999 investing in real estate. I don't know. I don't look that old. Thank you very much. But I know I look older than that, right, Matt? But anyway, we started investing in common equity. That's where I started. That's where you probably started. And most people do that. And it's the highest risk and the highest potential return or highest potential loss position in the capital stack. And most of us, if you started investing in real estate after the great financial crisis, you probably did really, really well for up to the next decade. Because honestly, there was a big run. I mean, the rising tide lifted all boats, as JFK said. The Jobs Act, social media, a lot of promoters came on the scene, and a lot of us were able to double our money in real estate investing as investing in syndications and such from, let's say, 2013 to 2022 or even 2023. But we had some problems. Now, the Feds, in their 11 rate hikes in 16 months, did not cause the problem. We all know that. There was a dry pile of kindling and wood already heaped up. And I think the interest rate hikes were just like a spark that lit that pile. It was destined to go up in flames at some point anyway. The problem, honestly, was a lot of syndicators, and a lot of them were newer syndicators who hadn't lived through the trauma of 2008, for example. These were syndicators who assumed that past rent hikes equaled future rent hikes. Rents in Tucson have risen 18% over the past 2 years, and we're only assuming 9% conservatively in the next 5 years. That's just not right. And, we should have known that. These were syndicators who overpaid for already overpriced assets. They used risky short-term floating rate debt. They, used unrealistic underwriting assumptions like 99% occupancy and decreasing costs in an inflationary environment. And they actually believed that trees, also known as rents, really would grow to the sky this time. But as we all know, trees never grow to the sky. And so we saw these problems developing in the market. We actually thought way back in 2017 things were going to go haywire. And, it took 4.5, 5 more years until they actually did. And so we pulled out and, we pulled back into a fund manager position way back in 2018 because, like I mentioned, a rising tide lifts all boats, but Warren Buffett said only when the tide goes out do you discover who's swimming naked. And wow, have we seen some skinny dippers these past 3 years, more than we ever wanted to see. So Wellings Capital pulled back in 20 January, or I think it was late 2022, and we said, "Hey, it's getting really hard to find deals. Risk and return don't make sense anymore." And there's a lot of uncertainty in the market. Of course, that was after only like 4 or 5 of the 11 interest rate hikes. We thought they would continue, and of course they did. And so we pulled into the safest spot in the capital stack. Our second iteration was investing in debt. It seemed like a good option, but debt offers cash flow, which lowers your risk every month that you get the cash flow. It offers a lien. It doesn't have tax write-offs, tax benefits real estate equity has, but it also has an extremely, as we know, capped potential upside. In fact, the upside is set in stone and it's real low. And we realized we wanted to get a solution, a third iteration that would combine the strengths of debt and equity. And that's when we started thinking about a little deeper about what Warren Buffett did during the great financial crisis. So what did Warren do? Berkshire Hathaway acquired a $5 billion stake in Goldman Sachs as it was dropping like a rock. Nobody else would touch financial stocks like Goldman and Wells Fargo, which he bought both of, with a 39.5-foot pole. But Buffett didn't take the risks that other investors took. Buffett dramatically lowered his risk when he invested in Goldman Sachs by investing not in common equity, but in preferred equity. Buffett bought right down here before the bottom of the trough. I mean, you can see, can you imagine buying when stocks were dropping at that rate? And that's what was happening with Goldman Sachs. And of course, a lot of others went out of business. And a lot of pundits, including a lot of employees inside Goldman Sachs, thought they were next, Bear Stearns, Lehman Brothers. But on I think it was September 25th, 2008, Buffett put his $5 billion investment in, and he did it in preferred equity. And now, of course, we know it rose dramatically the next couple of years, and Buffett and Berkshire Hathaway's investors made $3.7 billion in profit in a short time from the dividends and growth. So we wondered, would it be possible for us, would it be possible for real estate investors like you and I to follow a similar strategy? And that led to our third iteration, and that's preferred equity. If you've been around Wellings Capital very long, and we've been associated with Camoplan for years, you know that we've been bullish about preferred equity for a long time. In fact, over 50% of our $78 million in our Wellings Real Estate Income Fund consists of preferred equity, and our two current funds are almost completely focused on two different types of preferred equity, which we'll get into. So why do we love preferred equity? It has some of the advantages of debt and equity. The payment priority is ahead of common equity. It's got lower downside risk than common equity. Common equity is in first loss position, in other words. There's no lien like debt, but there is more upside and there are tax benefits similar to common equity, often the same. And we think it has a more compelling risk to return ratio. We really believe that it is the best product for investors during elevated interest rate periods and periods of uncertainty. But we really believed that this window could be closing at some point. For example, we noticed that interest rates would probably decline at some point. And if interest rates decline, it's likely that lenders would relax their terms and people wouldn't need preferred equity. They'd be able to refinance or do other deals without pref equity. Market uncertainty would probably recede. Capital raising activity would go back to normal. And let's just face it, good things like this don't usually last forever. Now, that was true, but at the same time, we came to realize after looking at about 1,800 deals in the last couple of years that there were other limitations to preferred equity. In fact, first of all, because there is a current pay cash flow similar to debt, and often that current pay is 9 or 10%, at least it has been for us, it can handcuff operators on certain investments, which means we can't access many solid operators and deals as the market gets better. And it caps our upside on the very best deals. So a similar, in a typical preferred equity deal might look like, 9% current pay cash flow. And then when the asset is refinanced or sometimes sold, we would get an additional 5 or 6 or even 7%. And we'll show you some of these deals in a few minutes. But what that would mean is, hey, yay for us, we lower our risk dramatically and we get like a 16%, I don't want to call it guaranteed, of course, but a 16% fixed return. But there are certain deals where we would have wished we weren't. We would have wished we were in the common equity seat. And that's like this one. This is just one I picked randomly. It's American Self-Storage in Oregon. We were the largest investors in this deal. You can see that the property level internal rate of return was 70% on this. If we would have invested in preferred equity in that and been capped at 17%, we would have missed a whole lot of that upside. So we were really trying to figure out something that would allow us to get the downside protection, the forced sale rights, the management control rights, the budget approval rights, the lower place in the capital stack, but also some of that upside. And so we finally came up after a couple of years of scratching our heads with a fourth iteration. Why do I do these things? I don't know. Anyway, the fourth iteration is JV hybrid equity. Now you'll notice this is the one of these four positions that's not on the standard return versus risk line, which means we believe that JV hybrid equity, and that's the name we gave it, has a little higher risk than preferred equity because there's no current pay, but it has similar or maybe the same returns as common equity. And this is the next spot in our evolution, this JV hybrid equity. Now, I want to be clear, it's a form of preferred equity. It is preferred equity because it is in the middle of the capital stack. It's got forced sale provisions, management takeover rights, all kinds of, JV provisions that allow us to step in if we have a manager that's going off the rails, and we can force a sale if it's about to be foreclosed to protect our investors' position. But it doesn't have the current pay. In other words, if we were getting 9% annually from a typical preferred equity deal, we wouldn't be getting that. We would be getting whatever the other common equity investors get. But at the sale, we'd also get the same ideal. whatever the other common equity investors get. So JV hybrid equity shares the advantages of preferred, and common equity. Common equity still in first loss position, which we love. The payment priority is ahead of common equity at the liquidity event, which means we get paid first if something goes south. We have the same unlimited upside like common equity. There's no lien like debt, but we get the tax benefits of common equity. There's limited management control rights, and this is opening the door for us to just reach a lot more sponsors. Like I said, it's not on that standard risk to return line, and we think it provides the most compelling risk to return ratio of anything we've seen. So I ran this JV hybrid equity idea by one of our investors when we were first looking at this, and they said, "Hold on, how are you getting deals like this?" Well, that same week, my wife and my daughter were going to Costco, and I realized how we were getting these deals. Now, Costco, because of its buying power, only has to mark up almost all of its products 14% compared to traditional retailers marking them up 25 to 50%. And they were able to do that by their incredible management skill and their buying power. And we really feel like the buying power is the key to this. I mean, we're typically bringing, if there's 20 million in equity, we might bring 15 million of it. And then, of course, the common equities in that last 5 million position, first subject to loss, though. So why do we pivot to JV hybrid equity? Like I said, it opens the door to many more opportunities. We think preferred equity is probably going to lose its appeal in the coming years. It still maintains many of the control and forced sale provisions we mentioned. There's a higher reward with a downside protection by being in the middle of the capital stack. Now, unfortunately, most individual investors can't do these deals. There's a ton of underwriting, due diligence. I mean, most individual investors don't have, I mean, really to make it make sense, at least $5 million to throw at one deal. Some family offices do these. In fact, they commonly do these. Institutional investors do them. Large investors or large investment groups can do these deals. But there's one catch, and that is that the senior lender, and often it's Fannie Mae, Freddie Mac, has to approve of the equity partner. And they want to know that we're going to be a good partner because they know that we'll be, you know, putting our hands in there and potentially moving things around. We'd be potentially the ones taking over management if things went south. And so that's a really important consideration.
Can I jump in there for a second, Paul?
Perfect
Uh,
timing.
so, uh, specifically, I am understanding that, you know, the differences between, or one of the main distinctions between preferred equity and this JV equity is that you're not getting necessarily the same sort of consistent annual return that you would at the preferred position, but you are achieving a higher return overall, and you're having the ability to step in and manage the project if things go south. That is my question: is when do through a JV or through the JV equity position, when do you have the right to step in and start taking control and start managing? What does your managing role look like, and where does it
Yeah.
start?
Well, we would never want to do that. Clearly, we pick sponsors that we really hope that would never cause that. But it would be certain triggers, like if we stop getting um, management reports, like they have to give us, profit and loss statements on a regular basis. If they drop below the debt service coverage ratio minimum, let's say it's, for debt, it might be 1.25. For debt and preferred equity combined, it might be 1.1. If they drop below that, um, if there's all kinds of things like that. If they just if let's say that the key manager resigns and now the property's just floundering. And that's true, that those rights are true for preferred equity or JV hybrid equity, Matt. So, hope that helps.
Yep. And one more question:
Yeah.
Does a JV equity position? I mean, I guess this is a simple question, but if someone is like Wellings Capital is coming in and taking that position, does that assume that there's no other preferred equity investor in the capital stack, and it's just the basically the first lien holder, yourself, and then the operator, or is there sometimes also a preferred equity position too?
Yeah, I can't think of a situation where there'd be more than one preferred equity
Yeah.
position.
Okay.
One thing I didn't go over is, since we're in a time of difficulty in commercial real estate, right now, a lot of people think preferred equity is rescue capital. And that's not the case. Rescue capital is a type of preferred equity, however. The types of preferred equity we've identified are number one, value add acquisitions, and we do those. Number two, refinancing to pull equity out of a successful project. We do
Mm-hmm.
those. We're on a due diligence trip to Chicago right now. My partner is looking at one of those. Number three, new development. We absolutely don't do those, but that's a great use of preferred equity. It's just too risky for our company. And number four is rescue capital. We've seen a lot of that the last few years. Rescue capital can be sort of like a replacement for a capital call. In other words, the company says, hey, we don't want to call capital common equity to give more capital, but we'll do the same thing by providing rescue capital or inserting it in the middle of the capital stack, like you see this 15% here. But again, that's not what we do, and we never plan to do that. Wellings has two funds. They asked me to talk briefly about our funds right now. So we have an evergreen income fund right now. We're targeting, though there's no guarantee, 6 to 9% annual cash yield, and then about 4% more from appreciation at the end of the day. So about a 10 to 13% annual return. It's, these are generally preferred equity and JV hybrid equity deals. We plan to invest, do this for decades to come. These are tax efficient. There's strong current income plus growth, and we broadly diversify this again across different asset types, geographies, operators, and strategies. This is a little bit more information about the Evergreen Income Fund. Like I said, we plan to have it open for a very long time. It has the flexibility. People can get out if they don't want to stay in. Our typical fund is more like our growth fund, however, which is a 10-year fund. We're targeting a higher total annual return, but there's no ongoing cash flow. So there's a little more risk. These are a little more steep value adds or redevelopment projects, things like that. Our current our growth fund is currently looking at an Indianapolis multifamily deal that's a value add with an experienced sponsor. So our growth fund is a little shorter, like I said, 10 years, not evergreen, $50 million target size. We pass through depreciation on both of these funds, and we invest in deals like this one. Now, this is a preferred equity deal. So this is a little richer than we usually get, but where is it? So this one it was a $6 million investment, but look at this, 10% current pay. And we've been getting that from them ever since we closed. And then a 5.5% accrued compounding upside, which means we should get a 15.5% total annual return. But really, since it's 3 years, that accrued compounding upside grows every year. So it's probably going to turn out to be about a 16 to 17% total annual return. So you can see our current pays senior to all other equity distributions. It's behind debt service, of course. We detach at 74.8%, which means 25.2% of common equity is in first loss position. We have a global debt service coverage ratio between debt and equity of 1.24x, which means there's a 24% margin of safety between the our last dollar of risk and where the income is performing right now. That's a preferred equity deal.
Is that insulation the about the 20? I guess it's the 25.2%. Is that typically what you like to see, or is this abnormal? How what is it?
Oh, yeah, yeah, it is 25.2. Yeah, that's what we like to see. We would go higher than that in some cases. I mean, this capital stack's very similar right here. You can see
Yeah.
they have 25%. Yeah, that's what we like to see, but we could go higher if the debt service coverage ratio was strong enough.
Mm-hmm.
We could go, instead of to 75%, we could go to 82, 83, 84%. We have a lot more things we have to look at, a lot more metrics. You can see this one. I think this one has a higher. I have to climb through here. This was a $5.4 million investment. It's got strong cash flow, 8.5% out of the gate. It's targeting over a 2x multiple at our level, over the hold time of 5 years. And there's only 15% common equity in first loss position. So we're going up to 85% on this. But Matt, look at the debt service coverage ratio right out of the
2.0.
gate.
Yeah.
Yeah. So there's 100% margin of safety or more
Yeah.
between the income and the debt payments on this. So it's really, really strong. That allowed us to go higher and bring more money to the table.
On
Any more questions on preferred versus JV equity? And then we're going to fly through and finish.
not on preferred or JV equity.
Okay.
So I'll let you fly through and finish. Then I have another question we can come back to.
Okay, so the secret sauce for Wellings Capital is our rigorous due diligence. Even since I made this slide up, we've expanded our 27-step process to 31 steps. I mean, my partner's making two headquarter and site visits this week. We do third-party net operating income audits, which they're like $10,000 per property, and the operator, pays that. We're looking for people with strong track record. We're interviewing a company right now that has a 34-year. They've raised over 3 billion, or they've done over 3 billion in deals. They're not all that lengthy, but that one is. So we really do focus on intrinsic value. Warren Buffett said, "Price is what you pay, value is what you get," and we're looking for that intrinsic value. Last year we looked at over 1,100 deals and only invested in six, which is like 0.53%, I think. This is and people can reach out to me and get a copy of this deck. These are all the full cycle investments we've made in Wellings Capital funds. The benefit of a fund, Matt, is, you get a deal like number five there in Minneapolis, St. Paul area during the tragedy, the George Floyd crisis, and we got a 9% loss on that small investment. But about that same time, we had another deal with a 60% gain and another with a 347% IRR. So the fund really cushions those losses. And there are losses. I mean, here's a few more. But the fund structure, I recommend to investors to get a stronger risk adjusted return, because remember, we're not going for the best returns. We're going for the best risk adjusted returns. These are refinanced investments. The second to last column is where you want to look here, that you can see the value growth in these different deals as they were refinanced. And
Yeah,
we've got,
we had a question come in
yeah,
that is right about these slides. It's related to these slides. So the
good.
question is, Are the funds a blend of investments or are they specific to an individual investment? And how does this impact returns?
Yeah, so the funds are all a blend across different operators, different asset types, geographies, etc. So, you can look in this column here and you can see that, a lot of these investments were in our fund one, two, three, and four. We got a piece of that in a lot of these. It's not always that way. Often they're just in one fund. Um, but we also have sidecar investments where somebody says, I really don't want to invest in a fund. I don't like that blind feeling like what are you going to do next? So they want to do one single sidecar, as we call them. And these are individual investments we would make, and we do those as well. Um, Here's our joint venture and preferred equity track record. You can see that all these earlier deals here were preferred equity. And you can look at, these terms over here. There's the current pay and preferred equity. It's like I said, it's pretty strong. And then there's also an accruing outstanding upside. We had one go full cycle already. It came out to almost 23% return, which was unusually good deal. Here's some more current investments. And now you can see as we go on in time, we get into more JV hybrid deals. We've got 3 JV hybrid deals here, and we've got another one we're working on now. So people say a lot of nice things about Williams Capital online. We got all 5-star reviews, 43 reviews right now. Please don't be the first non-5-star if you're listening. Um, I will sick my bobblehead on you if you do. So, um, anyway, uh, but we have a lot of investors, about 1,100, who mostly really love us, but there's a lot of good reasons not to invest in a fund. There's a lot of good reasons not to invest with Wellings Capital. There's a lot of good reasons not to invest in commercial real estate. If you need a liquid investment, don't invest with us. If you want a longer hold time, by the way, our evergreen fund is liquid, but only after 4 years. You want a longer hold time for your investments, or shorter hold time for that matter. If you love to be in control, you shouldn't invest with any syndicator or fund. If you like to file your tax return early, we will not be providing that, an early tax return. If you want diversification, or if you hate diversification, depends on which one you're looking at, if it's a sidecar or an individual fund. You can take a screenshot of this page if you would like to get hold of us, if you'd like to learn more about what we do. And I've got another contact page before we're done. But before we wrap up, Matt, there's something really, really near and dear to our heart that we always want to mention. Did you know that if you took the record profits, not the average, the record profits of ExxonMobil, Nike, and Walmart, and tripled that number, you'd come up with the approximate annual profitability of human trafficking? It's pretty stunning. And we wanted to do something about that. So we've raised, donated, and influenced about $1 million plus since we partnered with a group called AIM, AIM. Aimfree.org is their website. They do an incredible job rescuing children in Cambodia, putting the bad guys behind bars, and now they've expanded to Belize, which is a really, really bad trafficking hotspot as well. So here's another contact page you can screenshot. If you want to text me at my mobile number, you can do that. If you want to call us, if you want more information, we have some free special reports you can get, all kinds of stuff at our website. We'd love to connect with you if you're interested.
Awesome. Yeah, I don't want to ignore what the mention of AIM. So that's fantastic that you do that, and congratulations on being able to raise that money, and
Thank
congratulations
you.
on really having a mission behind what you're doing beyond just specifically the real estate strategies. That's fantastic.
Thank
Um,
you.
a question. So the question that I had earlier is, uh, so I just for a little bit of background, I used to work for a private money lender, and I became intimately aware of the difference between judicial and non-judicial states when it comes to foreclosures. Does that impact how you underwrite deals, or is it a consideration in the deals that you invest in, depending on whether it's a judicial or non-judicial state?
I don't know the answer to that. We've got a team of four people led by one of our longtime investors who joined us 3 years ago named Troy. And he probably would know the answer to that, but I can tell you that I don't. And if somebody specifically asks that, Matt, I can certainly get back to them.
Yeah. Okay. That was my question. So,
Okay.
um, all right, we did have another question come in. Do any of your investments provide depreciation benefits to your investors?
Yes, we always, except that one debt investment we made in the fall of 2022. Every one of our deals we negotiate to get pari passu, in other words, basically an equivalent amount of um, tax write-off, depreciation benefits as everybody else. And since we're usually doing the value add acquisitions, and especially with the tax law that got signed back into, 100% bonus depreciation as of July last 2025. Yes, we get a lot of tax write-offs. We get more on mobile home parks than we do on, let's say, self-storage, but we love to get every penny we can and pass it along to investors.
Awesome. You mentioned mobile home parks. I know you mentioned investing in self storage earlier in the presentation. If there was one asset class, only one that you could choose,
Mm.
one real estate asset class that you could choose to invest in today, what would you invest in?
I think if I was going to be holding for 100 years and, was passing this along to my great grandkids, I think I would invest in multifamily. But none of us are investing for 100 years. And so if I was just going to pick one that I would invest, in the next decade or two, it would absolutely be mobile home parks, manufactured housing communities. It's the only asset type, Matt, that has a decreasing supply and an increasing demand every year. And it has that year in and year out consistently. There really is an affordable housing crisis. 10,000 people turn 65 today, Matt, and 6,000 of them don't have $10,000 saved for retirement. But a lot of them have home equity they can cash in, and a lot of them will cash that in to live in a manufactured housing community, have more flexibility. They still have a yard. They don't have to share a wall with a neighbor. They get a deck. They get two parking spaces. And one of my best friends' father is a prominent doctor. And when he retired, he went to a manufactured housing community and he got to travel and enjoy his life and a lot lower maintenance and lower cost than owning a home.
All right. You heard it here, folks. Manufactured housing it was spoken on this podcast or this webinar. Those are all of the questions that I have. So I think, unless anyone wants to throw anything in at the last minute, I think we'll go ahead and wrap up today. So, Paul, this was fantastic. I really appreciate your time, your bobbleheads time, of course, and again, hats off to you and the Wellings Capital team for your support of AIM. For those of you who are watching, please don't hesitate with any questions that you didn't think of during the webinar. And you can always reach out to Camaplan. We'll get those questions to Paul. And otherwise, we appreciate you being here, and we'll see you on the next one.
Thanks.
Thank you, Paul. Bye bye, everyone.
Bye bye.